Hey, welcome back, Accounting 604. This is lecture number 2. We are continuing our conversation about stockholders' equity and what are the kinds of things we are looking for as we try to analyze this section of the financial statements. And you can see from this title slide in this deck, we are looking at stock issuances and repurchases, a topic that we touched on just briefly as we began to look at this section of the financial statements in the previous deck. Now, as we've mentioned, the issuance of stock is fairly straightforward, conceptually at least, right? Companies issue stock to obtain capital, cash for use in the business, or in some cases, this is the currency that may be used to acquire another company in mergers and acquisitions. And so you can see here, if issued for cash, stock issuances increase cash by the issue proceeds, and equity increases by the same amount via contributed capital. If the stock has a par value, then the common stock account increases by the number of shares sold multiplied by par value. And of course, in J&J's case, that's just $1. But of course, we expect the stock is sold for far more than $1 per share, and that additional amount is calculated as additional paid in capital and is going to be listed either as APIC or a case in Johnson & Johnson's case, it's simply swept into the retained earnings number over the life of the company. And so you can see here from the financial statement effects table that we've been using in this course in the textbook, the financial effects of issuing let's say 1,000 shares of stock, right? You can see here there's a $1 value, and so let us say that $100 per share was the market price when these shares were issued, and so people were paying $100 per share for stock in J&J. Then from a financial statement effects perspective, you see how this table works out. The company has raised, by selling 1,000 shares, $100,000, and you see the allocation of this in contributed capital. 1,000 of it is shown as common stock, because that's the par value, right? And then the additional $99,000 shows up as additional paid in capital. Pretty straightforward conceptually. You can see here, this is now a disclosure from Coca-Cola, the Coca-Cola Corporation, right? The esteemed sellers of high fructose corn syrup to America's youth. All right, so you can see the excerpt here. Their par value is a quarter, 25 cents per share. Okay, and you can see here, while of course this is in millions, right? While they have authorized 11.2, they have actually issued a slightly smaller amount of that, right? Just about 7,000. Right, and so you can see here it reports, they report a capital surplus, reinvested savings, right, accumulated other comprehensive income. Again, we'll talk about that in a future deck. Some shares still held in treasury at cost, right, and therefore the equity attributable to shareholders of the Coca-Cola company summed up for 21 and 22. And you see the notes below that of the total authorized, the 7,000, or in millions of shares, of course, right, of common stock is really valued at 2582. 1760 represents the par value, and the rest is additional paid in capital, right? So you can see how that works itself out, right? The 18,822 is in the contributed capital account, right, of APIC, which therefore is represented here as capital surplus. At least that's how it's stated by Coca-Cola, right? And so the average issue price, you can see there, right? If you take the total value of common stock, divide that by the number of shares outstanding, that's how you get the average issue price of $2.92, despite the fact that we have a 25-cent par value. Now, we then turn from the topic of issuing stock to occasionally repurchasing stock. Why might a company buy back its own shares at some subsequent date? It could be because the company believes the market is undervaluing them, and so repurchasing the shares will offset the dilutive effect of having too many shares in the marketplace, right? And so you reduce the underlying number or pool of shares outstanding, each share of stock becomes more precious, more valuable. And therefore, that is why in some cases, a company might choose to reduce the amount of outstanding shares, the number, by rebuying or repurchasing shares and placing them in treasury. Treasury then is seen as a contra equity account, which is why it will be shown with a negative balance, reducing the outstanding shareholders' equity. For J&J, you can see there that over time, over the years, J&J has repurchased a total of about 500 million shares at a total price of about $41 billion, right? An average price of about $82 per share. So these are shares that now are legally owned by J&J, and therefore they don't have any voting rights. They're not going to receive dividends. They're just held in treasury. They could be resold if J&J at some point in time wants to raise additional capital, or they might be used and kept there because they represent shares that will essentially at some date be used to compensate employees in stock-based compensation plans. That's another reason why a company oftentimes will make sure that it has sufficient shares in treasury. More on that in our next lecture deck, stock-based compensation. Continuing on with this topic of repurchase of shares into treasury stock, if you see a transaction, for instance, here an example, J&J repurchasing 200 shares of common, right, and paying $120 per share, you can see what happens here. It will pay out $24,000 in cash to wherever they're purchasing it back, and then that $24,000 is offset with this contra equity account of $24,000, a negative balance of $24,000 in treasury stock. Assume perhaps that at some future point in time, 200 shares of that treasury stock are then resold out to the market and sold for $125 per share. You can see what would happen. That share of stock would bring in $25,000 to the company, which would then be offset by the $24,000 that it represents in treasury plus $1,000 in additional paid in capital. That, of course, is just simply mathematically the way that the additional capital is accounted for from an accounting perspective. Occasionally, shares might be repurchased and then retired. Retirement is a permanent effect or declaration that the company has no ever intention of reselling these shares to the public, and therefore it is canceling them, it is repurchasing them and canceling them from ever being issued. If in this particular case J&J repurchased 200 shares which were originally issued at $100 a share, and then having paid $120 per share, retires them without ever having the intention of reselling them, you can see the financial effects of how this plays out, right? Cash is decreased by 24 grand, and then you can see the reduction from the common stock account, right? Because it's being retired from common stock. And then also the retirement of additional paid in capital and the reduction in retained earnings. Microsoft has actually done this. You can see here the actual effect of common stock repurchased and the retirement or the reduction of retained earnings. And that's one of the reasons why in this particular case with this reduction, why in this particular year Microsoft reported a relatively low balance for retained earnings is primarily because of the effect of stock repurchase and retirement. Some insights into this then. Well, as you can see here, there is some capital structure flexibility that management will use stock issuances and repurchases to manipulate these kinds of things. And that's not necessarily a bad thing, right? It is an expansion and a contraction of the equity base that the tools being used, respectively stock issuance and, of course, stock repurchase. There is the question of, well, what is the economic substance of potential stock retirement? You can see that essentially it permanently shrinks the equity base, and so that's something that should be used sparingly and wisely. You should need to have real intent behind that. There is a strategic use of treasury that goes beyond earnings per share. You can see there that you can take treasury and resell it to raise capital. You can use it for mergers and acquisitions. You can allocate it to executive compensation. It is, in a sense, a form of shadow currency that can be used for growth and maneuvering of your capital structure. So all of this is, of course, reviewed in the textbook as well. So we will see you in the next video.